Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, markets have had a solid run again this week. What's driving the optimism?
Well, it's a bit of a cocktail. Some comforting inflation data, stabilizing macro prints, and a drop in oil prices that's helped ease inflation expectations. That's been enough to steady the ship. The VIX, for example, has dropped to 18.3 from a recent peak above 50. That's a huge shift in sentiment. But here's the thing. We're still sailing through fog. The tariff burden, even after the recent truce, is well above historical norms. It's like replacing a Category 5 storm with a Category 3. It's better, but it still does damage. And that's going to show up eventually in margins, in prices, and in demand. Yes, the S&P has had a strong year-to-date run. Some analysts are even revising their year-end targets higher. But let's not confuse short-term relief with long-term resolution. Policy risk, inflation uncertainty, and geopolitical fragility haven't gone anywhere.
What does the latest U.S. data tell us about the real state of the economy?
In short, not much, or at least not with clarity. Retail sales in April were in line with expectations, but March was revised up sharply, the strongest monthly gain in 2 years. That likely reflects pre-tariff stockpiling, not organic strength. Add in a 1.2% increase in restaurant and bar spending, and it tells you the consumer is still standing, but possibly front-loading activity. Producer prices down 0.5%. Services prices fell the most since the index began back in 2009. That's not exactly a roaring endorsement of demand, and yet, bond yields held steady. Even a warning from Walmart saying they'll have to pass on higher prices due to tariffs didn't rattle markets. The Powell speech was similarly brushed aside. He warned that long-term rates may need to rise due to supply shocks, but the market clearly wasn't in the mood to hear it.
So, the U.S.-China trade pause is being well received. But is it durable?
Let's call it what it is. A ceasefire, not a peace treaty. Both sides agreed to roll back some tariffs, and markets cheered. The S&P surged 3.3% on the day of the announcement, but the deal is only for 90 days. It's more of a cooling-off period than a fundamental shift in policy. That's created a whiplash effect in global trade. Shipping had virtually halted between the US and China. Now there's a scramble to move goods before the window closes. It's going to make interpreting upcoming data, especially trade flows and confidence surveys, pretty tricky. And let's not forget the backdrop here. Global supply chains are still adjusting to years of disruption, and now they're navigating an artificial deadline. It's chaos in slow motion.
There's also talk of a nuclear deal with Iran. What's the market read-through there?
That story's still unfolding, but it's already impacting oil prices. Brent crude gave up its recent $2 gain on speculation that Iran could roll back its nuclear ambitions in exchange for sanctions relief. That would add barrels to the global market and extend the disinflationary tailwind that's been helping sentiment. Now, if that deal materializes, it would be a clear positive for Middle Eastern markets and a welcome development for global inflation. Lower energy costs would take pressure off central banks and potentially cushion consumer spending. But again, let's not get too far ahead of ourselves. We've been here before.
Big picture. What are the risks markets might be overlooking right now?
Complacency. We're in a phase where the absence of bad news is being treated as good news. But structurally, there's still a lot to digest. U.S. deficits are ballooning. Powell is warning about long-term rate pressure, and the Fed is boxed in, unable to cut without inflation relief and unable to hike without triggering pain. Then there's geopolitics. The India-Pakistan flashpoint may have cooled, but the fact that it happened at all is telling. The global order is looking increasingly fragmented, where bilateral deals replace institutions and volatility replaces coordination. And in markets, that shows up in narrow leadership, weak breadth, and sudden rotations. The high-yield spread tightening is encouraging, but it's also happening in a market that's ignoring a lot of macro risk.
That's it for this week. Stay tuned for more insights next time.